Hey, hello again. It's Greg Josephchuk, your premier Lake Norman, Lori Lawrence Century 21 real estate agent here in Mooresville, beautiful Mooresville, North Carolina. Coming to you today from the Mortgage Planner's office in beautiful Davidson, North Carolina. And my guest is Jacob Roche. And today we're going to be talking about the topic, Jacob, today is going to be first-time home buyers.
Yeah.
And the process from a mortgage broker, mortgage lender, process of what does a first-time home buyer have to prepare for? What do they need to go through? What is the process? And are there any unique programs that are unique to first-time home buyers? Okay, so those are going to be the different topics and questions, and I'll let you take it from there.
Let's do it. So thanks again for having me on, for sure. First thing I always say is, like, they'll come in and they'll say, what's the first thing I should do? Always number one, have credit. That being the biggest piece. Make sure that you have credit established, at least open a credit card, and so when I pull your credit, you at least have 3 credit scores from all 3 bureaus. That has me off and running right away, and out shopping and whatnot. From that point, I would say once I get credit, I look at their application. Depending on income and things like that, there are less first-time home buyers in the market typically, and I've seen stats over the years that the first-time home buyers' age continues to increase, partially because of rates and lifestyle changes. But what I always say is that there's a lot of programs out there to take advantage of with being a first-time home buyer that a lot don't even know about. In terms of process, you'll submit an application. My team reviews it. We get approval. Might need a couple documents from your W-2s, pay stubs, depending on how you're paid, 1099s, tax returns. But per every application, we'll request documents specifically after we get it reviewed. But from that point, you're off and shopping, the fun part, right? So then you go under contract. You'll negotiate a great deal for them, like always. But from that point, we go through. Might need a couple more docs to submit to processing. You'll go into underwriting. They'll conditionally approve you. And conditionally means give me a couple more documents I might need to say, okay, look, everything looks good. You get the clear to close, and then you're closing. And then you get a brand new house. And what a lot of first-time home buyers don't know, that if you close on the first of the month, you actually skip about 2 months payments. You don't skip, right? But you pay interest in closing costs. But you don't have a payment for almost 2 months. So you can plan it out. If you're leaving a rental, which a lot of people do, they want to move, and then, right, you want to make it easy on yourself, in other words, so you won't have a payment. You can pay. I did it personally. I had my apartment sitting empty in Charlotte. I moved out, and I was living in this house. Well, I had payments there, and then when that lease ended, I was making mortgage payments at that point. So what I always say, just have your documents in order. When you get your W-2s, pay stubs are pretty easy to access. Just make sure that you have your documents in order, and even if you are planning, and reach out and see what your buying power is, see how credit is, if there's anything that I might need to recommend. But I would say that's mainly the starting point.
So let's talk a little bit about what are the documents? What are the typical documents? Because again, remember, I've never gone through this process before. This is a first-time home buying experience for me. Maybe I'm a little nervous. I'm not really sure what kind of paperwork's going to be asked of me. So can you maybe shed a little light in that area?
Big process. So not big process, important process. So what I say is 30 days, most recent pay stubs. Depending on how you're paid, meaning if you get commission, bonus, if you're hourly, those are considered variable pay, meaning you both work on commission, things like that. So I always run it through underwriting before. Make sure that we use a 2-year average. So if you have commission for 60 days, unfortunately, I won't be able to use that. Now, if you're W-2, salary, very straightforward. I take your salary income, divide by 12, there it is. Now, 2-year average for hourly, 1099, meaning independent contractors, self-employed. So we always want to make sure that we have those ducks in a row. But those are the main documents that we need. Photo ID, we actually have really great, actually we don't even really need bank statements anymore. We have a great program called Finicity where you link your bank account. All we can see is transactions, balances, and that's really, that makes it a lot easier on documents. In addition to, you can link your payroll too. So I might not even need your pay stubs. Sometimes we need year-end pay stubs, but not too much documents to it. I always advise, get your application in, let us look at it. Your approval is good for 120 days. So, and what I mean good, all I need to redo is re-pull your credit, and I always do a soft pull, so you don't get a hard inquiry until you say, hey, I found the one. And then at that point, let's do a hard inquiry, and then make sure everything is in a row, in other words.
Excellent. Now, let me ask you something. How does credit all play into this, and something called credit scores?
It'll depend what program you go with, right? So FHA is, I would say, typically if you're going minimum down payment, which lower down payment typically for first-time home buyers, I would say 600 plus if you're going 3.5%
credit
down.
score.
Yes,
Credit
yes, 600 plus credit score. Yeah, sorry.
Right, that's all right.
3.5% down payment. Now for conventional, I'd say 700 plus for 3% down typically. And that varies, right? It can depend on, like if you go 5% down, I might get approval just under 700. But sometimes, in some cases, I might recommend FHA because it's a much lower payment versus conventional. Rates are about 3/8 lower right now on FHA. And then in addition to, if you have a high debt to income, your mortgage insurance on conventional will be more expensive. Well, then I might, let's say your rate is at 0.8 for conventional mortgage insurance. FHA is always at a set standard of 0.55. So depending on debt to income, loan to value, there's a lot that goes into it. So I might, if your goal is I want the lowest payment possible, I'll tell them a few different options, but it's typically the lower payment will be FHA. Now, in terms of like products, I would say the biggest one being our two, I guess you could say. We have zero down products. Obviously, we do minimum down payments, 3% conventional or 3.5% FHA. We have zero down FHA, we do have zero down FHA, zero down USDA, Gerda, VA as well. But going back to the 0% down FHA, that's not typical. Really what we do is the traditional 3.5% down FHA mortgage, we come on top and finance that. It's always more expensive when you go zero down unless you go to what's called NC housing or NC FHA. It's through the state and they have average interest rates, like right now they're at 6.5. So right around the market, there's no points charged, which is awesome. But they literally give you $15,000 for down payment and closing costs. If you go and buy a $300,000 house, that $15,000, $9,000 will go towards down payment or 3%. And then the rest really pays for your closing costs. So you can really get a great deal. And I've had clients, I have one going right now where they're walking into a house, I have estimated payment at $17 due at closing. So you can buy a house with $17. It's a pretty good deal today.
Wow, so you've kind of thrown a whole lot at me right now, which is great. And I'm thinking I'm the new, the first-time home buyer. So one thing I enjoy working with you as a partner is that you will actually show the different programs and break it down for them kind of on a column and line-by-line basis, correct? So that they can see how the different impact is for the different programs that you just walked them through, whether it's FHA or conforming or whatever they may qualify for, correct?
Yeah, exactly.
And essentially show them that if you put this much money down, this is with this mortgage rate. Ultimately, this is obviously what you're going to be paying monthly as your mortgage for your mortgage, correct? And you'll also factor in things like property taxes, homeowners insurance, things like that, so that they understand kind of this is how much essentially I'm going to be paying for, and this is how much I qualify for for a mortgage, for a loan.
Absolutely. We do a total cost analysis. So really, if you come in and you say, I want my payment here, I'm going to show you, here's how the standard looks. Here's how if you negotiate seller credits, here's how it looks if you go zero down. And I can put all three next to each other. I had one client come in, he was a younger guy, and he said, I want to go 20% down. I said, any reason specifically? He was a young guy, I think he was around 26, 27. I want to go 20% down on about $350. And I said, any particular reason? He said, well, I just want to avoid mortgage insurance. I said, well, if you look at this column, I'll show you exactly what you want. It's 20% down. Here's what I advise. If you go 3% down, your payment with mortgage insurance, about a quarter higher interest rate, it was a $500 or $511 more in payment. But I said, take that other 60 grand, put it with a financial advisor, put it in the S&P. You're going to see, and I showed him, because I can also do this on our total cost analysis. There's a bottom right column where it says, in the next 7 years, your investment, and I actually did it conservatively, because he told me he wants to go build in 7 years. in those next 7 years, his total net worth was 60 grand higher with a $500 payment more than putting 20% down. So going into the house, less money in, your house is still going to grow at 350 appreciation at 3% versus if it's at 3% down payment versus 20, it's still going to appreciate at 3%, where now your money's working in both. You see what I mean?
Yeah, so what you're really saying is, first of all, money is money, right?
Yeah.
And if you can take and save your money and invest it in a place where maybe you're getting a 6, 7, 8% return,
Yeah.
versus taking that same amount of money and using it as part of your 20%
Exactly.
down payment, right? And you can get them into a lower down payment, take that money that they save instead of 20%, right? Whether it's 5%, 3.5%, take the remaining money, put it into an investment that's paying 6, 7, 8%,
Exactly.
and 5, 6 years down the road, boy, you're going to have a nice little nest egg
Yeah.
here.
Having a couple investment pockets is really the purpose, just so that your money's not sitting idle, essentially locked up in your
Locked
house.
up in your house.
If you come back to me, I'm going to have to requalify you to get it back out.
Right.
Cash out refinances are about 0.5% higher on average. So I say keep your money in your pocket, cash is king.
Right, and the key being, as long as you can afford to make that mortgage payment, like you said, might be $500 more a month, but if you can cover that, you are miles ahead of the game.
Exactly right.
Absolutely. Well, Jacob, I really appreciate it. This was great advice, and I enjoy being your mortgage lender friend and partner, and this has been a great day. So thank you guys for tuning in, and we'll see you on the next episode.